Hey everyone, and welcome back to your Money Your Way YouTube channel. Today, we're diving deep into the Singapore stock market based on a detailed analysis of its performance in May 2025. We're looking at a fascinating picture here. The market showed some great short-term momentum, but it's happening against a backdrop of real economic caution. If you're invested in Singapore or thinking about it, stick around, because we're going to break down the key trends, investor behaviors, and look at some major stocks based on our research. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. So, let's start with the market itself. The Straits Times Index, or STI, which is Singapore's benchmark index, actually wrapped up May 2025 on a positive note. In fact, specifically during the week leading up to May 29th, the STI showed positive momentum, extending what the report calls a win streak over 3 consecutive trading sessions. It advanced over 40 points, roughly 1%, during that period, closing slightly higher on May 29th at 3,916.84 points. This suggests a prevailing positive sentiment among market participants during that specific week. However, and this is the critical part, this market buoyancy exists against a more cautious macroeconomic outlook for Singapore. The official word from the Ministry of Trade and Industry, as of May 22nd, maintained the 2025 gross domestic product, or GDP, growth forecast at 0.0 to 2%. Now, this might sound okay, but it was actually a downgrade from the earlier 1.0 to 3% projection made in April 2025. The primary reason cited for this revision was a significant deterioration in the global economic outlook, mainly due to escalating US-China tariff tensions. Looking back at the first quarter of 2025, the economic performance also showed moderation. Year-on-year growth was 3.9%, slower than the 5% in the previous quarter. But even more critically, on a quarter-on-quarter basis, the economy contracted by 0.6%. This sequential contraction points to a softening of economic activity. Certain sectors like wholesale trade, manufacturing, and finance and insurance did propel growth in Q1. Interestingly, a significant factor was front-loading activities ahead of anticipated US tariff hikes. This means some of that strength might be temporary, driven by businesses ordering early to avoid future tariffs. Consumer-facing sectors, on the other hand, saw contractions. The government has explicitly stated they are not ruling out the possibility of a technical recession. Economists in the report echo this caution, with projections suggesting a further deceleration in growth could lead to a technical recession. So, you have the stock market showing a short-term positive trend, potentially looking ahead, but the underlying economic data is flashing some yellow, if not red, lights. This highlights why just looking at the index performance isn't enough. You need to understand the broader economic picture. Adding another layer of complexity is the divergence in investor sentiment observed in May. The report highlights that institutional investors were net sellers, with outflows of over 121 million Singapore dollars for the week of May 19th. In stark contrast, retail investors were net buyers, although their activity slowed slightly. This split suggests different investment approaches or risk appetites. The report provides a table of top buy and sell stocks for each group. For instance, institutional investors were net buyers of stocks like Singapore Airlines, SIA, ST Engineering, and Keppel, but net sellers of major banks like DBS, UOB, and OCBC, as well as Singtel and SATS Limited. Retail investors, meanwhile, were net buyers of Yangzijiang Shipbuilding, OCBC, and SATS, but were actually major net sellers of SIA. This contrasting behavior could mean institutions were rebalancing or taking profits, while retail investors might have been focusing on value or specific catalysts. Let's now zoom in on some key sectors and stocks highlighted in the analysis to understand where opportunities and risks lie. First, the banking sector, including DBS, OCBC, and UOB. Despite being top institutional net sales for that week, their Q1 2025 results were generally resilient. They showed strong underlying business growth, thanks partly to diversified income streams like wealth management and trading fees, which helped offset pressure on net interest margins. Their balance sheets are robust, and they've set aside prudent allowances for uncertainties. The report sees them as fundamentally sound, dividend-yielding blue chips suitable for long-term investors seeking stability and income. In the industrial and marine sector, companies like ST Engineering, Ceatrium, and Keppel appear to be strong candidates. ST Engineering and Ceatrium boast substantial order books, providing excellent revenue visibility. Ceatrium, a top institutional buy, has a significant order book extending to 2031, with a large portion in renewables. Keppel, another institutional buy, is successfully transforming into an asset-light, sustainability-focused business with growing recurring income. Yangzijiang Shipbuilding saw institutional selling but retail buying, potentially due to a short-term dip in Q1 order wins. However, analysts maintain a positive long-term outlook, driven by global maritime decarbonization trends. The real estate and rights sector presents a mixed bag. Capitaland Integrated Commercial Trust, CICT, an institutional net buy, showed resilience with strong performance in its core Singapore assets, particularly impressive retail rental reversions. Its prudent financial management and focus on sustainability make it an attractive income-generating asset. In contrast, Hong Kong Land, while seeing institutional buying and strong past price performance, faces significant profitability challenges, largely due to its exposure to the volatile China property market. Analysts project substantial downside, so the report advises extreme caution and thorough due diligence for this stock. Finally, the aviation and services sector. Both Singapore Airlines, SIA, and SATS are benefiting from air travel recovery. However, their situations differ. SIA reported a record full-year profit, but the report notes this was significantly boosted by a large one-off accounting gain from the Air India merger. Its core operating profit actually declined due to competition and rising costs. Analysts are cautious, projecting significant downside. SATS, on the other hand, shows a more robust operational rebound with strong growth in its core segments like cargo and aviation meals. Despite some operational and debt challenges, the report suggests SATS might be a more compelling recovery and growth play in the sector. So, what does all this mean for investors? The report offers several key recommendations. First, given the mixed signals, selective stock picking based on thorough fundamental analysis is crucial. Don't just follow the broad market trend. Focus on companies with resilient business models, diversified income streams, and robust balance sheets. Stay informed about macroeconomic headwinds like recession potential and trade tensions. Critically, when looking at company profits, evaluate the sustainability of earnings. Differentiate between one-off gains and core operational performance. For stability, consider dividend-yielding blue chips. Always assess company-specific risks and consider integrating ESG factors into your analysis. Finally, keep an eye on leadership changes. Navigating the Singapore market right now requires a discerning approach. While there's short-term positive momentum, the underlying economic uncertainties demand caution and careful selection. That wraps up our look at the Singapore stock market based on this May 2025 analysis. Remember, market conditions can change quickly, so always do your own research or consult with a financial advisor. If you found this helpful, please give us a thumbs up and subscribe for more market insights. Let me know in the comments what Singapore stocks you're watching. Thanks for watching, and I'll see you in the next video.